Then moving from the P by E ratio to the next, the price to book value. The advantage at least is even during a situation where the EPS is negative, there is a possibility that the book value of the company is positive, which means the price to book value ratio is existing as a positive quantity even if the company is making a loss. For those companies, the price to earning ratio may not have a meaning, but price to book value ratio definitely makes a lot of sense. And what has been observed is the book value of the company is much more stable compared to the earnings of the company. So I can very well expect that the price to book value ratio also will be much more stable compared to the price to earnings ratio. And especially for financial sector where there is a large holdings of liquid assets, big and these liquid assets keep upgraded with their values continuously. The book values are a good reflection of the market value, because it's as good as you are purchasing a lot of them. You might have done the purchase of a lot of these assets pretty recently, which is a reflection of the market value of these assets. So the book values, especially in the financial sector, the book values of the assets more closely reflect the market value of the asset. So because of this reason, the price to book value is a very important multiple when it comes to the financial sector firms. And even for firms that are expected to go out of the business, which are not expected to generate any kind of revenues in the future, even for those kind of firms, I can rely on the price to book value ratio for a comparison purpose. And just like a P by E ratio, it has been observed that whatever the differences that are cropping up in the P by B ratio over the time, they are majorly related to the differences in the long-term average returns of the stocks. So because of that relationship, it's very much appropriate to use price to book value ratio as a measure of the long-term equity returns on that particular stock. But if I look at the book value, the non-physical assets which are not present as a part of the financial statements, like the human capital, which is not captured in the book value of the assets, or similarly the brand value of the company, and many other non-quantifiable elements of the company, non-quantifiable assets of the company, they are not present as a part of the book value, so even the price to book value ratio ignores them. And significantly different levels of assets are used by the companies. In some cases, different levels of assets can very well be used by the companies. And if that's the case, the price to book value is going to lead to various misleading numbers. And even the accounting differences play an important role, because the book value is coming again as a matter of the if I'm looking at the earnings is what the earnings or the net income of the company post the dividend is what is going to the retained earnings, which is what is coming up to the book value of the equity. Now, because of this reason, the accounting differences across the companies could lead to a different net income, which could have an impact on the book value per share heavily. So, across the companies, these differences can really change the price to book value ratio across. And book value of the assets are based on the historical cost adjusted for accumulated depreciation. But when we are talking of those assets acquired long time back, inflation, changes in technology may result in significant differences. And even the share repurchases can impact the price to book value comparison. So at the max, all we are looking at is some advantages being existing to this price to book value. And as a computation, we are saying it's a market price per share divided by the book value per share. So as an analyst, if I have to use the price to book value ratio for comparison purposes or for valuation purposes, I have to make a few adjustments. There is a need that the book value should be a reflection of the shareholders' investment. And it should be adjusted in such a way that I should be able to compare it across companies. So for that reason, if there are any intangible assets, especially goodwill, if there are any intangible assets, especially goodwill, we suggest that the analyst should remove that from the total assets and the shareholders' equity has to be adjusted accordingly. Because the goodwill is not a separately identifiable asset. It is just an overpayment for an acquisition. So while considering the book value, it should be removed from the assets and the shareholders' equity needs to be adjusted accordingly. But that need not be done for the patent because the patent can very well be segregated from the main and it can even be sold separately also. So as an adjustment to the computation of the book value, one major change that is suggested is take out the goodwill. Similarly, an analyst has to make certain adjustments to eliminate the effect of the accounting differences because some companies might have followed LIFO based accounting for inventory whereas some could have gone with FIFO based. If that's the case, I have to make the necessary changes to reflect across the different companies. Both of them have to be brought onto the same scale to enable a better comparison across the companies. And similarly, if there are any off balance sheet assets and liabilities, they all needs to be considered. Different kinds of leases, any other off balance sheet activities, they must be accounted in the calculation of the book value. So the different balance sheet values, especially which are more and more associated with the historical cost method, it is better that their values are revalued, that they are revalued to reflect the fair value of the asset. Of course, with an IFRS form of reporting, almost every asset is revalued to the fair value. So in that case, there may not be any big issues. But if still the historical cost method is being continued, a small adjustments regarding the reflection to the current value needs to be done. Alright, let's look at one quick example for computing the P by E ratio. P by B, price to book value ratio. Common stock is 261,000. Preferred stock is to the extent of 19095. Okay. Additional paid in capital is around 1200. Retained earnings 54054. Total shareholders equity Okay, total shareholders equity should come to the summation of these four, right? The total shareholders equity is 335349. Yeah, that's the one that is here. Market price of the stock is $14 a share. So now I want to compute the price to book value ratio. Now I require the book value per share first of all, right? Market price per share is there. So let me compute the book value per share. So how do I get the book value per share? First let me compute the book value, which comes out as the total shareholders equity. Out of it, the preferred stock should not be there for me, right? Preferred stock I am subtracting because I am looking at only the book value of the common equity. Book value of common equity is this much. So I can find out the book value per share, which works out to this divided by the number of shares 26,100. So the book value per share is around 12.12. The market value is around 14 per share. So price to book value per share is coming out to 14 divided by 12.12, causing around 1.16 to be the price to book value ratio. So that's how the simple calculation can be taken care of.